Hey there, Vita volunteers. Welcome to Capital Gains and Losses. Let's take a look at the definition and topics we are about to discuss. Here's the definition of a capital gain. Capital gains are usually income derived from stock sales, but can also be from the sale of a home. We're going to talk about the holding period for capital assets and how to enter this information into TaxSlayer. Sale of a main home is treated somewhat differently, so we'll learn how to see if the home qualifies as the taxpayer's main home. We will discuss the 5-year ownership and use test that can qualify a taxpayer for a substantial exclusion from the overall capital gain amount. We're also going to talk about how to calculate a taxable gain and enter that into TaxSlayer. Loss on the sale of a main home is not deductible, so we don't have to worry about reporting a loss. There are certain situations where the 5-year ownership and use test can be suspended, so we'll get into that as well. Let's talk about the basis of an asset. Basis is the purchase price of the asset plus any adjustments due to fees, commissions, etc. In the case of a home sale, capital improvements factor into basis. If the basis of an asset is not provided, we will not be able to prepare the return. Generally, the broker or agent will track the basis of an asset. The same stock may be bought or sold, there may be stock splits, and dividends could be reinvested over time, so the tracking of the basis can be tricky. If the stockbroker can't provide the basis, the taxpayer must calculate the basis themselves. For an equity, if the basis is not on the Form 1099-B, there are some options. The client can ask their broker to research an asset and provide the basis. If a client knows the approximate date of purchase, the basis can be obtained from a historical stock value website. Again, if there were several transactions against the same asset price to the sale in the tax year, the client is responsible for coming up with the basis price of the asset. In the case of an inherited asset, determining the basis is relatively easy. The basis of an inherited asset is the full market value of the asset on the date the inheritance was received. This applies to gifted assets as well. So while receiving a gift or inheritance is not a taxable event, the sale of that gifted or inherited asset is a taxable event, and we need the basis to determine the tax liability. There are two types of holding periods, short-term and long-term. The short-term holding period is 1 year or less. Short-term sales are taxed at the taxpayer's marginal rate. The long-term holding period is anything more than a year. Long-term sales are taxed at a progressive rate beyond the taxpayer's adjusted gross income. The current long-term tax rates are 0%, 15%, and 20%. Inherited assets are always taxed using the long-term holding period, no matter how long the taxpayer actually possessed the asset. They could receive an inheritance one day and sell it the next, and the asset would still be a long-term capital gain. While a sale of a stock can be reported on a Form 1099-B, the broker will usually send the taxpayer a consolidated brokerage statement of which a 1099-B in the brokerage house's own format is included. If the preparer enters the date of sale, basis, and net proceeds, TaxSlayer will do the calculation to determine the taxable amount. TaxSlayer will also calculate the appropriate short-term or long-term tax rate. A wash transaction is the sale of securities as a loss and the acquisition of the same or substantially identical securities within 30 days of the sale date. This is sometimes done for tax loss harvesting, but if it is determined to be a wash sale, the loss is added to the cost of the new stock, thereby increasing the cost basis. It's as if the transaction never happened. An uncovered or non-covered security is a designation given by the U.S. Securities and Exchange Commission, which means a brokerage is not required to report the cost basis of the security to the IRS. The adjusted cost basis of non-covered securities is only reported to the taxpayer, not to the IRS, if the basis is calculated at all. It is common to see capital gains reported in Box 2A, Total Capital Gain Distribution of Form 1099 DIV, usually for mutual funds. Just enter the Box 2A on the TaxSlayer data entry screen, and TaxSlayer will add the amount into the capital gains forms. Here is an example of a consolidated brokerage statement. All of the same boxes from a 1099-B are right there on the page. If there are multiple transactions, the brokerage statement may group the transactions by long-term and short-term, and by whether the basis was reported to the IRS or not reported to the IRS. When entering these group transactions into TaxSlayer, we can group them also, so you don't have to enter each stock individually. All brokerage statements are different, and you need to read them closely. Most statements will have a summary page, but the devil is in the details, so you must read the whole statement. If entered properly, TaxSlayer will determine whether the asset is a long-term or short-term gain, profit or loss from the sale, and any resulting tax liability or deductible loss. TaxSlayer will also record capital loss carryovers, which we'll talk about later. Be sure to check the brokerage statement to see if it includes a Form 1099 DIV with an amount in Box 2A. The TaxSlayer Capital Gains Transaction screen is under the Federal Section Income, Schedule D, Form 8949. Form 8949, Sales and Other Dispositions of Capital Assets, itemizes each short-term and long-term transaction and carries the result to Schedule D. Schedule D, Capital Gains and Losses, combines that information with capital gains reported on other forms, like a 1099 DIV, and calculates the total gain or loss. This is then carried to the Form 1040. If there is a capital loss, TaxSlayer will also create a capital loss carryover worksheet that we'll talk about on the next slide. Taxpayers can deduct capital losses up to the amount of their capital gains plus $3,000. This total is only $1,500 if married filing single. A loss carryover can occur when losses exceed gains or when there is not enough taxable income to absorb the net loss deduction. The prior year's short-term and long-term carryover losses are combined with the capital gains and losses in the current year. Unused capital losses can be carried over indefinitely into later years until they are completely used up. The prior year's tax return is required to report capital loss carryforward. Without the prior year return, we have no way of knowing about it. Look for a negative number on the previous year 1040 line 7 for capital gain. If there is a negative number, look for the capital loss carryover worksheet from the previous year to find the amount to be carried over. Enter a TaxSlayer note to alert next year's preparer. If the taxpayer had consented data carry forward last year, TaxSlayer will do all the capital loss carry forward entries for you. Be sure to check TaxSlayer's work. A home is a capital asset. A home can be subject to capital gains, but not capital losses. There is a special exclusion of the first $500,000 of gain for qualifying homes. This total is $250,000 if single. This applies only to the taxpayer's main home that meets the ownership and use tests in the next slide. Vacation homes, rental homes, and bare land are out of scope. However, a home can be a houseboat, mobile home, condo, or co-op. A second home could qualify if it meets the ownership and use tests in the next slide. You only have to report the sale of a main home if the taxpayer receives a Form 1099-S from the closing agent, or if the gain on the sale exceeds the $500,000/$250,000 profit maximums. If a married couple sells a home for less than $500,000, or the closing agent determines that the gain is below the maximums, they may not issue a 1099-S. In that case, nothing is entered into TaxSlayer. If a 1099-S is received, it must be entered into TaxSlayer. Interview the taxpayer to make sure they meet the ownership and use tests on the next slide. In order to qualify for the 500K/250K capital gain exclusion, the taxpayers must meet these ownership and use tests. Over the 5 years preceding the sale, the taxpayer must have lived in the house for at least 2 of those years. That's the ownership test. and they must have lived in the home as their main home. For example, they get their mail there, their driver's license has that address, they vote from there, etc., for at least 2 years of the past 5 years. That's the use test. Also, during the last 2 years, they can't have claimed the 500K/250K capital gain exclusion on another sale transaction. If the home, or any portion of the home, like renting a room, was rented or used for a business, the home sale is out of scope due to the need to calculate depreciation. For example, there's a couple in my neighborhood who own a home down the street and they own another home in a nearby neighborhood. They used to rent the home down the street, but they moved into that home a year ago and will be living in it until they pass the 2 year use test. They will then sell the home using the 500K capital gain exclusion and move back to their other home where, 2 years later, they can claim another 500K capital gain exclusion if they sell that home. They get the exclusions, but since they use the home down the street as a rental, their tax return is out of scope for VITA. We cannot do home sales for homes that qualified for depreciation regardless of whether the depreciation was claimed or not. For persons serving in the military, foreign service, intelligence community, or Peace Corps, the 5 year ownership and use tests can be suspended. The adjusted basis is the purchase price of the home plus any major improvements, not including maintenance, that are made to the home. We'll talk more about basis on the next slide. Figuring the gain or loss on the sale of a home is based on selling price, amount realized, basis, and adjusted basis. If a home is in joint ownership, the homeowner dies and the spouse has rights of survival, then the ownership of the home passes to the surviving spouse. At that time, the basis price of the home is reestablished to be the full current market value of the home. This is sometimes called a step up in basis due to the death of a joint owner. For clients who have lost a spouse during the year, we advise them to get an appraisal on their home. And once again, if you sell a home at a loss, that loss is not deductible and does not qualify for capital loss carry forward. The clips above are from IRS publication 523, Selling Your Home. If you know that you have a client coming in with a home sale, refer them to this publication so they come into their tax preparation appointment with the home's adjusted basis. They will probably have to do some digging to recall what was done to the home and find the cost to be applied to the basis. Good records are needed to calculate the adjusted basis. We don't need to see those records, but the IRS auditor will ask for them if necessary. To recap, any capital gains resulting from the sale of stocks, bonds, mutual funds, exchange traded funds, or a main home is out of scope. We cannot do digital assets like Bitcoin, Dogecoin, Ethereum, or any other digital asset. We cannot do a return with a capital gains transaction where the cost basis for the transaction or the holding period cannot be determined. We do not do like-kind exchanges or worthless securities. A like-kind exchange occurs when you exchange real property used for business or held as an investment solely for another similar business or investment property. Worthless securities are financial instruments, such as stocks or bonds, that have lost all their monetary value. This could happen for various reasons, including bankruptcy, liquidation, or other forms of financial failure by the issuing company. If any of the 1099-B barter sale boxes are checked, or if the Foreign Account Tax Compliant Act box is checked, that transaction makes the return out of scope. We cannot do transactions involving homes with deductible casualty losses or postponed capital gains. Sale of a home used for business purposes and a rental property is out of scope because it involves depreciation. In this lesson, we talked about the sale of a main home and how to report it. We reviewed the ownership and use tests that would qualify the seller for a 500K or 250K reduction in gain for a main home. We learned that the 5-year test period can be suspended for taxpayers serving on qualified official extended duty. Remember, if a client receives a Form 1099-S for sale of home, they must file a tax return even if they are below the reporting thresholds, and we must enter the sale of the main home on Form 8949 and Schedule D. We'll see you in the next lesson on in-home health services.